The central bank's decision to hold interest rates steady sends a powerful signal to markets, investors, and consumers. It suggests that current monetary policy is sufficiently restrictive to cool inflation without halting economic momentum. Although no rate cut was announced, the language and tone of the statement, as well as economic projections, offer key clues about the direction of rates and how investors can position themselves strategically over the next 1 to 5 years. Holding rates indicates the bank is in a wait-and-see mode, observing the delayed effects of previous hikes on inflation, growth, and employment. Inflation is likely still above target but trending lower, while job markets remain resilient and financial system risks are contained. This decision buys the central bank time to assess whether inflation will continue to fall sustainably without triggering a recession. If the announcement included dovish language, such as hints of disinflationary pressures or concern over slowing growth, it increases the likelihood of a rate cut within the next year. Conversely, any reference to upside risks in inflation or persistent wage growth would suggest a higher for longer bias. Looking ahead, the most probable outcome is a gradual decline in interest rates starting within the next 6 to 12 months. Over the next year, expect 1 or 2 small rate cuts if inflation continues to ease and economic data softens. This would bring US rates into the 3.75% to 4% range and Canadian rates to around 4.25% to 4.50%. Over a 3-year horizon, rates will likely settle into a neutral zone around 2.75% to 3.25%, consistent with a stabilized economy and inflation near target. By year 5, structural forces such as an aging population, high debt levels, and productivity gains may drive policy rates even lower, potentially in the 2.5% to 3.0% range. The era of aggressive tightening appears to be ending, and investors should position for a softer, more accommodative rate environment over the medium term. This shift creates compelling opportunities across several sectors. Real estate investment trusts, REITs, for example, stand to benefit significantly. These were hammered by rising rates and are poised for a rebound as financing costs stabilize and cap rates compress. Industrial REITs like Prologis, residential names such as Canadian Apartment Properties REIT, and data center plays like Equinix all offer attractive entry points. Similarly, utilities and infrastructure stocks regain appeal, especially those with inflation-linked revenues. Brookfield Infrastructure Partners and NextEra Energy are strong picks, combining yield with long-term growth drivers such as clean energy transition and global infrastructure investment. High-quality dividend-paying stocks are another area of opportunity. With yields stabilizing, the relative attractiveness of stable dividends improves. Canadian stalwarts like Fortis, global consumer defensive stocks like PepsiCo, and strong banking franchises like TD Bank offer income and capital appreciation potential. For growth-focused investors, this is also the time to re-enter beaten-down tech and long-duration growth names. Microsoft offers a solid mix of profitability and AI exposure, while Shopify is showing improving margins and expanding globally. Nvidia remains a core holding as the AI megatrend continues, and its valuation becomes more palatable in a falling rate environment. Consumer-facing sectors tied to housing and discretionary spending should also see a tailwind. Lower mortgage rates improve housing affordability and stimulate new construction and renovation demand. US home builders like Lennar, home improvement retailers like Home Depot, and retailers like Canadian Tire that are sensitive to financing conditions could all outperform as consumer confidence recovers. Strategically, investors should shift away from ultra-defensive positioning and begin tilting portfolios towards sectors and companies that benefit from declining interest rates. In the next 12 months, REITs, dividend payers, and utilities provide stability and income. Over a 1 to 3 year horizon, growth and tech stocks, cyclicals, and infrastructure assets gain ground as monetary policy normalizes. By the 5-year mark, expect strong performance from small caps and international equities as global growth stabilizes and capital becomes more freely available. This rate hold isn't the end of the monetary policy cycle, it's a transition. It marks the top of the rate hike era and opens the door to a more balanced, growth-supportive environment. Investors who rebalance out of cash-heavy or bond-heavy positions and into high-quality equities stand to benefit most. The key is to focus on companies with strong cash flows, healthy balance sheets, and exposure to long-term tailwinds like AI, electrification, and housing demand. Like and subscribe if you want more macro-driven stock analysis and investment strategy breakdowns tailored for this new phase of the market cycle.